Hi, I'm Jason Brown, the Director of Advisor Success here at Foster Group, and we're here today to talk to you a little bit about cryptocurrency. So, want to introduce a couple of my colleagues, Ryne Oller. Ryan, why don't you introduce yourself?
Hey, my name is Ryne Oller. I'm an advisor here and been with Foster Group for about 4 years now.
And someone you might be a little bit more familiar with, that's Kent Kramer.
Kent Kramer, I'm the Chief Investment Officer, been an advisor at Foster Group really since 2001.
Kent, you were a little hesitant on that intro.
Hesitant. Well, you didn't say something, so I just.
Anyway. So welcome. We're just going to jump right to it. So we're going to start with Ryan here, who's one of our resident experts on cryptocurrencies. So Ryan, why don't you tell us what a cryptocurrency is?
Yeah, let's start with the second part of that word, the word currency, because I think everyone understands that word. So if I hired a contractor to build a deck for me and I wanted to compensate them, he's probably not going to agree to trade that service for like my 2000 Pontiac Grand Prix. Even if it had real value, which it certainly doesn't, trading an asset like a car is just a really clunky way to compensate the contractor. So that's how exchanging for goods and services used to work. But now over time, currency and modern money has been created to fill that gap. And so now when I go to pay the contractor $5,000 for building that deck, his confidence in that payment actually being worth $5,000 is backed by the full faith and trust of the US government. And so the US government actually controls its monetary policy. And if you've been paying attention at all in the last year, that's gotten a lot of attention as we printed a lot of money. So the monetary supply is controlled centrally by the US government. And the concept of a currency outside of a central body's control had been a pipe dream for quite a while. There had long been a vision to create a monetary policy that existed out of any single entity's control. So when the first cryptocurrency, Bitcoin, was created in 2009 by Satoshi Nakamoto, that wasn't created in a vacuum. That was really the result of many years of individuals trying to develop and implement a digital decentralized currency.
So I know obviously I've done some thinking on this too and some reading, but all of these cryptocurrencies are related to something called the blockchain or blockchain technology. Could you talk with us a little bit about the relationship between cryptocurrencies and blockchain?
Yeah. So in its simplest way of understanding it, a blockchain is just a ledger or a record of what's happened. And with Bitcoin specifically, I'll just dial into Bitcoin because I think it's the easiest to understand. Bitcoin's blockchain actually just records who owns what, and then if they move money to and from, who are they passing it to? So that's the short answer. But if we want to drill down deeper, we can certainly go there. What do you think, Jason?
I think that the people listening might appreciate a little bit of a deeper dive into what Bitcoin is, or sure, what Bitcoin is, but what blockchain is.
Right. Yeah. So, okay. We talked about currency, easy to understand, but the first part of the word of cryptocurrency, crypto is a little harder to understand. And crypto is just short for cryptography. And that comes from the Greek word kryptos, meaning hidden, which is actually where we get the word cryptic, which is super ironic because understanding cryptocurrency is really mysterious. And cryptography has been around forever. It's just the method of protecting information and communication through the use of codes. So it's just basically the process of encrypting and decrypting information. And one of the earliest examples we have of this is when Julius Caesar of the Roman Empire would use a cipher to communicate to his governors and officers. And the reason why he used a cipher was he didn't trust his messengers. He was nervous that they would be able to interpret the message and misuse it. So he came up with like a mechanism to scramble the messages so that they couldn't interpret it, but his intended audience could ultimately actually understand it. So that's really just cryptography right there. I think that's fairly easy to understand, and militaries have been using cryptography forever. And so let's say I need to pay a friend back. I need to send them $10. I'm probably going to use something like Venmo to do that. And Venmo just connects into my bank account. And my account at the bank is just a record of my cash activities. It's just tracking what I've done and what my running balance is. And just fundamentally, we entrust a bank to act as the gatekeeper and messenger of our financial information. But what if there was a way to actually transfer and record value without a middleman? What if there was a way to just do it directly? And that's where the blockchain comes into play. So I'm gonna go one layer deeper here to really get into kind of the details of how this works. So let's say instead of using Venmo, I'm gonna send $10 of Bitcoin to my friend instead. And that Bitcoin transaction actually gets added to a block on the Bitcoin blockchain. And it's validated and confirmed there in a decentralized fashion. There's no middleman in this process. And instead, there's actually computers all around the globe. They're all working simultaneously to confirm my transactions, but our identities and the financial information are actually stored and validated in a cryptographic and anonymous way. So that block has my transaction on it, and it's encrypted in a way where it's virtually impossible for any single person to actually to be able to decipher that puzzle. But once that puzzle does get solved, that block gets added or chained to the blockchain, hence the name blockchain. So now we have a bunch of blocks that all have data, and they're all chained together in such a way where the information remains anonymous and it remains unchangeable. And so this actually requires a ton of computing power to do this. That's been in the news quite a bit, but it does require a bunch of energy and computing power to do it, and it's not a cheap process. But this is essentially what's called the mining process, and the computer that solves the puzzle gets rewarded for helping validate and confirm the blockchain. And so if financial transactions are going to be publicly distributed and validated online through it in a decentralized way, there's got to be a really rigorous and robust deciphering mechanism in place to ensure that the blockchain is legitimate and that the data is secure. And so really, you can think of the blockchain's value deriving from the public's faith in the underlying process. And so Bitcoin kicked this all off back in 2009 formally, but now in 2021, we actually have thousands of different blockchains with their own cryptocurrencies. Bitcoin continues to be the dominant player and probably actually the easiest to understand, but there are many others with similar attributes trailing right behind it.
So, Ryne, I'm going to repeat back to you what I think I heard, and this is admittedly very much a lay person's definition here, but essentially what this technology does, in the same way that if you hand me a dollar bill, I can sort of know you're handing me a dollar bill.
Yep.
Blockchain technology is a way of confirming when somebody has a Bitcoin, and that it might move from one person to the other, so that everybody who's a part of that can know where all of the Bitcoins are with almost 100% certainty at any one time. Is that correct?
Yep, that's certainly right. And then there's also the monetary, the network of it. So monetary policy. Last year, U.S. government's printed money to create stimulus. You also have with something like Bitcoin its own monetary policy, and Bitcoin has a hard cap of 21 million Bitcoins. And so the actual inflation of that money supply is known. It's actually programmed into the blockchain. So that's not only do you have that anonymous nature of sending money and that assurance that I do have that money in a digital form, I also have the assurance that the monetary system is what it is, and that it's not going to change down the road.
Got it. And there's no third party that gets involved in this transaction. It's just person to person.
Yep, that's exactly right. There's all kinds of computers and different players in this, in a decentralized way across the whole globe. There's not a single entity that controls this process.
Okay. So a question I have that comes to mind, and we're going to go a bit off script here today, but I know I've talked about this with the two of you, is there any sort of asset that we're more familiar with? Because, you said it's cryptic, Ryne.
Yeah.
That maybe could give us sort of an idea of what a cryptocurrency is.
Yeah. So I think actually, even though we spent time talking about currency, I think thinking of Bitcoin specifically as a commodity is an easier way to understand it. Because, for instance, if I go to the coffee shop and I want to buy a coffee, well, we know that Bitcoin is very volatile. So When I buy $3 worth of coffee, if I were to use Bitcoin, I really don't know, depending on the moment, if I'm buying $2.70 worth of coffee or $3.30 worth of coffee. And so right now it's a very unstable version of a currency. And I think it really acts more like a commodity, and it has a lot of attributes similar to gold. So it's commonly referred to as digital gold.
Okay. Kent, anything you want to add to that at all?
I think that's right. I think commodity is probably the closest thing to it. I mean, a commodity it's not a company that's producing income. It's not a bond or some kind of a CD that's producing an interest rate. It's a thing. And in this case, it's, some commodities are physical things, gold, corn, whatever it might be. This is a digital thing. And what that thing is worth is what two people agree on paying for it at the time. So, there's no income, there's no profitability. This thing doesn't produce anything. And yet people want it for some reason. And the reasons vary, but they decide on the price and what that thing's worth at the time.
Yeah.
Thanks. That's I hope pretty helpful. It was to me when we talked together, and I hope it is to our listeners as well. Speaking of things, something else that I've heard about are NFTs, or that we've heard about, non-fungible tokens. And what's the difference between an NFT and a cryptocurrency?
Yeah, NFT, that's a fun word. Fungible is not a word that's thrown around a lot. So I think a lot of people are scrambling to understand what that means. But let's just use an example. So money as we know it, the US dollar is very fungible. So I can split it up in a number of ways. And if I split a dollar into 10 cents, I just have 10% of a dollar. It's very fungible. And if I exchange that for another 10 cents, I know that the other 10 cents is 10 cents. Whereas something that's not fungible is like the Mona Lisa. It's like a collectible or an art. You can have a counterfeit of it, and there's plenty of them, but there's really only authentically one Mona Lisa. And if I were to cut the Mona Lisa in half, like I don't have the Mona Lisa at all now. If I cut that in half, it's not the same thing. You can't devise it the same way you can with money. So that's non-fungible tokens are essentially that in a digital form, and those are on the blockchain as well.
And so, in other words, it's like a digital Mona Lisa, and the blockchain is what confirms that you have the actual Mona Lisa.
Yep, that's exactly right. That actual authentication and record of Jason owning the digital Mona Lisa, that actually lives on the blockchain, and you can have 100% certainty that yes, I am the owner of it, and everyone else can know that as well.
Okay. So one of the goals that we had for our time together today is that everyone would be leaving with a little bit better sense of what actually cryptocurrency is, what the blockchain is, its relationship to cryptocurrency, and a brief definition of an NFT as well, because we think that it's really important for us to actually understand what these things are. But Kent, I think the question that all of us are asking is, should we exchange these things called dollars for things like cryptocurrencies and or NFTs?
Yeah, that is the question of the question of the year, the question of the hour. I spend, a number of mornings, I've got a bike in my basement that I ride, and I usually have CNBC on in the morning. And the thing that struck me recently is when they're running through the day of, okay, where are the pre-market prices? You used to see, you'd see the Dow, you'd see maybe the S&P, you'd see the 10-year Treasury. Well, now in that same rotation, I see the Bitcoin price every morning. And so it just strikes me like, wow, the world is really asking this question. Like, this is something, it seems legitimate because it's getting all this time and attention by financial media. So one way to answer your question, Jason, when we talked about this earlier, I reached around behind me on my shelf back here because I have a dice. Actually, it's a silver dice, and on the sides are words like never, don't know, yes, no, maybe. And that question about should I invest in Bitcoin or not, I'm tempted just to throw my little silver die here and see what the answer is, because depending on the evaluation period, it's really hard to tell. There's Bitcoin price or digital asset prices, Ethereum, other kinds of currencies. They're going to move in price today, tomorrow, over the next year. the idea is it's as an asset to predict what it's going to do in the future price wise, I think is very, very difficult, if not impossible. There are as many different opinions amongst very bright financial professionals and other people who are talking about it now. So we'll see. I guess my answer there is I don't know. I think people who want to participate, there's reasons to and probably reasons not to as well. And I think we're going to talk about that here in a little bit.
Yeah. So, but I am going to make you get to that stuff, by the way. So let's take 2-3 steps way back. And I guess the question is, why exchange these very tangible things called dollars backed by the full faith of the US government for anything at all? And oftentimes we call that investing when we exchange dollars for something else. Why do we?
Yeah, I think that's the place to start, is why invest at all? So that's the first question. Why invest at all? And the reason we invest, or that people invest dollars today, because they invest in things that they think are either going to provide cash flows back to them today, or hopefully increase in value in the future. Because what we're trying to do by investing today, giving up the use of that dollar today, is we're trying to help that dollar to be worth more, hopefully the same or more in the future. And the investments that most people are familiar with is, well, stocks and bonds. So why buy a stock today? And the reason that people will buy a stock today is because they're buying an interest in a company that hopefully is producing profits and also maybe has physical assets. And I'm going to bring up an example of that, because people will talk about Bitcoin and they'll say, well, and the detractors will say, this thing has no intrinsic value. And what they mean by that is really, there's no way to value it in a traditional sense. So a traditional valuation model might look like this dividend discount model. And what it's based on a company, a stock that's paying a dividend to the underlying investors. I'm using Walmart in this example, but the discount model says, well, there's a dividend that's projected to be paid. And in Walmart's case, it's paying 55 cents a quarter or $2.20 a year right now in a dividend. So the projection is next year's dividend, or this year's dividend will be that. Then there's this cost of capital, which is kind of the required rate of return by investors. And what's going to happen, and then there's that rate is going to be used to compute a price. And we're also going to kind of guess on the growth rate of Walmart, in this case, their dividends. So the formula looks like the dividend divided by the cost of capital minus the growth rate of the dividend. And we won't get into all the math on that. But the idea here is, if you do that formula and you look at Walmart today, you say, well, there's the $2.20 dividend. If my cost of capital, the required rate by investors, is approximately 4%, the growth rate of the dividends in the past has been 2%, that works out to a price of $110 a share. Walmart, when I checked it yesterday, was trading at 141. So you can see it's not like a precise measure, and you're making a lot of assumptions in this model. But the thing to remember is there is a cash flow. The $2.20 is a cash flow back to the investor. Now, Walmart also has a lot of real estate and a lot of property, and they have this forward look on earnings. But foundationally, when people talk about what has intrinsic value, oftentimes they're talking about a cash flow back to the owner. And so that's true for a stock. It's also true for a bond. But in the case of a digital asset like Bitcoin, there's not a cash flow, which is why when we talked earlier, it's much more like a commodity like gold, where you're maybe thinking of it more of a speculative asset than what traditionally would be called an investment asset, where there's a known cash flow coming back to the investor.
Okay, so let's we thought a little bit about why we would exchange for anything at all, and you gave us some insight into one of the ways that we might think about the value of a particular asset. What are some of the reasons given for exchanging dollars for a cryptocurrency in NFT, things like this?
Yep. So think about it again, kind of that why invest in anything? One of the reasons to invest in anything is you expect capital appreciation. You expect the thing that you buy to go up in value. That is fundamentally, I think, the reason most people are participating in cryptocurrencies today is they look at the price today and they think the price tomorrow in the future of that same asset is going to be higher. And there might be a variety of reasons why it might be higher. One of the big reasons is the more that people participate in that market. In other words, the more generally accepted this market is, there'll be more demand, just kind of classic supply and demand. You look at Bitcoin, what Ryne said is, hey, there's a fixed supply, 21 million Bitcoins, I think is what you said. And the idea there is, okay, if there's a fixed supply, but more and more people want to buy those coins, then naturally the price level of the coins should rise. Well, that means the people who are the early adopters who are buying at a relatively low price should be rewarded for kind of taking that risk of future appreciation. The other thing I'd say about Bitcoin too, and this one, I think in the original paper, I was listening to the founder of Coinbase the other day, and he was talking about his fascination with cryptocurrency started when he read the original paper by Satoshi Nakamoto, where he was talking about governments or economies where the currency was kind of unprotected. So think Venezuela or Argentina, where the currency is going to be debased dramatically by government policy or something like that. I mean, they had inflation in Venezuela, I think it was in 2018, of 130,000%. Okay, that's 1 year. So your Bolivar at the beginning of the year was worth a lot less at the end of the year. Well, if you're a Venezuelan and that's kind of your banking system, you're stuck, buying Bolivars. But if you have a system of payment or a system of currency outside of the government system, you could have exchanged your Bolivars, bought Bitcoin, and when that Bolivar devalued 130,000% because of currency inflation, your Bitcoin on the global level was not subject to that government policy or those kinds of things going in the economy. So I think a real natural holder for Bitcoin, and probably one of the original things that made it such a fascinating idea, was that, again, you could get your money, if you were, your purchasing power out of local currency, especially if you're worried about the viability of local currency in the future. And so a natural holder for Bitcoin, rather than just a person who's speculating, might be a person who's really worried about the viability of their currency or their economy.
Somebody who's taking on a great deal of risk just simply by having their own currency.
That's exactly right. That's exactly right.
Yeah, and I'll add something there. I mean, cryptocurrency is full of ironies, and one of the ironies is that Kent, you nailed it. Some people may be attracted of converting their local currency to Bitcoin because of the government policy, but some of the largest holders of Bitcoin are Americans, and we've had really steady inflation, right? The debasement of the dollars has not been dramatic like Venezuela. So in a sense, Americans are helping bootstrap this whole concept of a decentralized currency for the sake of maybe others, for the sake of other people. My lights just went out. 1 second. So that's one of many ironies that I find interesting, is that I think it's hard for Americans to wrap their head around the need for this, or like what's the problem that's really being solved by this. And so it remains to be seen whether Bitcoin or other cryptocurrencies will actually solve any problem. But it's Americans are helping lead the way in building the infrastructure out.
Ryne, you've been doing a great job of sitting. We were instructed to sit very still for this.
I should have had someone come in and just stand right there by the sensor and wave every 5 minutes.
Yeah. Nice.
Kent, I want to go back to the comment on, there's kind of a place potentially for speculation. I'd love to hear more about that.
Yeah. So, well, let's think about any kind of asset and go back to kind of this idea of, we think something that I can buy today will be worth more tomorrow, and put any asset that you're interested in into that formula. Maybe it's artwork, mentioned the Mona Lisa. Maybe it's a commodity like gold. Maybe it's a small startup company that has some really interesting ideas about biomedical engineering. They've got an idea that they think could resolve a big health problem. In a startup company, just like in other kinds of speculative investments, most startup companies are not profitable. So you go back to that idea of a dividend discount model or some kind of a cash flow model for valuation. Well, you know what? That company's burning cash. They are not profitable. They are losing money hand over fist in pursuit of developing intellectual property. And with the idea that intellectual property in the future could be worth a lot. So here's the thing, that's a very speculative investment, because I can't predict with any kind of certainty whether or not that company is going to be successful in developing that drug or therapy or whatever it might be. But it doesn't mean that it's a totally wrong investment to make. It just means it's a very risky investment to make. And people who want to speculate, and there's all different kinds of ways to speculate. I would say Bitcoin is a type of speculation. Many people who are involved in commodities are doing a type of speculation. There are natural holders for commodities. I mean, corn producers, farmers, and people who use corn to produce ethanol, they're natural holders of corn. They have a reason. The corn producer wants to sell it at a price. The ethanol plant wants to buy it at a price. But there's a lot of people in between the grower and the ethanol plant who are speculating every day buying corn futures. And that's kind of helping to set the price. Well, the same thing's happening kind of in the digital asset world. There's a lot of people in the middle of who might be natural holders for digital currencies. They're speculating because they're willing to take the risk that this thing that they're speculating on today will be worth more tomorrow. Now, let me just share a quick picture here of kind of what speculation can look like. And why it's not for the faint of heart. So this picture shows the volatility of Bitcoin just in 2021. Now, this is an amazing chart because right down here in the lower right-hand corner, you can see small company stocks in the US are up 16.3%. That's a pretty decent investment return for the first half of the year. And it's kind of this line, it's the yellow line in all the bottom lines here. Well, that looks pretty tame compared to this line up here, the Bitcoin line that looks like a mountain going up and then coming all the way back down. So Bitcoin's return to the speculative investor this year, if they invested on January 1st, they're up about 24%, which, hey, that's not a bad return, but it was painful. If you were a holder the whole way, you saw this thing go up over 120% at one point from its January 1st starting point, and then losing, a lot of that value on the way back down. And if you were one of the people who started to pay attention right here, let's say in March or April, so now you're buying when Bitcoin's trading at 50,000 or 60,000 as opposed to the 36 or 37 that it's trading at recently, and you bought up here at the top, then you felt the pain of speculation kind of gone wrong. If you were buying at the beginning of the year and you sold in March or April, you enjoyed, the benefit of speculation done right. The idea here is it is a risk. And the idea of taking that kind of risk is pretty interesting, I think.
And to add, it trades 24/7. So that you don't get any breaks with cryptocurrency, whereas the stock market's just open for, during the day, Monday through Friday. Cryptocurrency trades all the time. So you go to bed and you wake up the next day, you might be down 20%. And so, if you can just kind of set it and forget it, maybe that helps a little bit, but it's definitely a different animal with its volatility.
Yeah. One more thing that I just wanted to note on this chart is the bottom three entries here, they represent exchange rates. So the US dollar to the yen, the US dollar to the pound, the US dollar to the euro. And, it's not that currencies aren't without volatility to each other, that kind of exchange rate, but you can see, 5%, 3% flat with the euro to the US dollar. So there's very little volatility in those currency exchange rates. I think what Ryne was saying earlier, that the idea of Bitcoin today as a currency, it's a little bit of a misnomer because it'd be very hard to use as a means of exchange because the volatility from day to day, or just as you mentioned, from hour to hour overnight, you have a hard time pricing things if the value of your pricing is changing second by second, day by day dramatically. Whereas down here on these other exchange rates, there's day-to-day volatility in those exchange rates, but not nearly to the degree that we're seeing with cryptocurrencies today.
So Kent, if we're the type of person, many of us, maybe we're not interested in this, but if we're the type of person that likes to shave off a little bit of our income, and let's say and has the capacity to do that, or some of our wealth, what is your advice in general, just on how to think about that? If there's an itch that we need to scratch about, speculating on anything.
Yeah, I totally understand, I think, the itch. We've been around, all of us have been around investors, people who, it's important that they do good financial planning to make good investment decisions, because in the future, those investment decisions are going to have significant consequences as to whether they achieve their goals, have a secure retirement, fund college, whatever it might be that people are doing financial planning, kind of investing for. So with that in mind, the way that I look at any kind of speculative investment is that's okay as long as it's kind of measured in a way that if that speculative investment completely fails, that it will not significantly affect your ability to achieve your financial goals. That's really, people laugh, but some people go to Las Vegas and they'll gamble on a card game or roulette wheel, or maybe they used to go there because that was the only place that they could kind of get engaged in sports betting. Now you can bet on sports, all over. So that's a very speculative activity. Most people are doing that for entertainment, hopefully. And they know that going in. I might win, I might lose, but I'm not expecting to make a ton of money in that. I'm expecting to have an experience. So that's one level of kind of speculation. I think what we're talking about with digital assets are kind of one step away from that, where it's like, no, this is more than just entertainment. I'm actually thinking there's some economic sense to this. And what I would say is there might or might not be economic sense to it. We don't know relative price-wise where we are today, whether we've inflated something and now it's way overpriced and it's going to go down in the future, or whether it's really a nascent, idea. It's so new, so young, that maybe this thing has a lot of legs in it and is going to grow dramatically in value in the future. It's the same thing as a small company stock, that one that we talked about developing a drug. We don't know where that thing's going to end. Because of that, you may have a sense of, hey, I think this is something that I want to participate in because I believe in it. It makes sense to me. And if I don't, I'm going to feel like this sense of FOMO, this fear of missing out. So the danger is I'm going to participate too much and put my total financial plan at risk. The other danger is I'm going to get so frustrated in not scratching that itch and not participating a little bit, that at some point in the future, I might make a really bad decision just because I've been not allowing that pressure to release. I think with some investors, there's a little pressure valve where they just need to let off some steam once in a while and go ahead and express an idea, but do it in a way that's under control. It's not going to torpedo their plan if it goes bad. So I just have a picture here of kind of an asset allocation, a very broad level of a portfolio. And in this case, 95% of the portfolio assets are dedicated to that long-term, kind of more traditional way to think about investing, and very, very diversified. So if something goes wrong with one thing, I haven't torpedoed my entire financial future. This little speculative slice here, though, that's kind of a place where, well, maybe I want to own some digital assets with that money. Maybe I want to, speculate on a particular stock, or I want to own another commodity, whatever it might be. If you can kind of work with your financial advisor to figure out, well, how much of my portfolio could I really afford to speculate with, knowing that if it goes to zero, I'm still going to be okay, my family's going to be okay, this is going to be a responsible approach to this, then that part, that slice of the pie, if you will, I think is a perfectly good place to do that. Some people, they don't have that itch at all, and they shouldn't feel like, wow, I should be. It's like, no, if you don't really feel that itch, don't feel drug into it. At the same time, if you just can't stop thinking about it and you're going to feel like, man, if this thing goes from 37 or 38 today to 37,000 in the case of Bitcoin, let's say today, and it goes back to where people say, hey, it might get to 100,000, and you're going to be at 100,000 and looking at it going, why didn't I at least do some?
Yeah.
Then maybe today you want to slice off a little bit and do some, just to kind of say, well, if it goes bad, it's not going to be the end of the world, but if it goes great, fantastic.
That's good. So maybe this is inherent in some of the comments you made. By the way, that last little bit I think is really helpful too for all of us, frankly. What are some of the reasons that we shouldn't invest in this new stuff?
Well, I will say this, it's very volatile, right? I mean, one of the things we've seen just in the last few weeks, even just the decline in price in Bitcoin and other digital assets. And I think it's volatile and it's relatively small in terms of the total market. I looked at some numbers a week or so ago, and the total cryptocurrency market today, if you look at Coinbase or some of these other sites, it's about 1.6 billion, I think, or 1.6 trillion, I'm sorry, which is smaller than the market capitalization of Apple Computer. It's smaller than the market capitalization of Amazon. So when you think about, how big of a market this thing is in terms of its global footprint, relatively speaking, it's not that big, and it's really, really new. So all this volatility is just kind of the world trying to shake out what to do with this new thing. And then you look at certain opinion leaders, Mr. Musk, for example, an asset that can be that volatile based on somebody tweeting or commenting on Saturday Night Live, you just have to step back and go, I'm not sure the investment case is firmly established for this thing if it moves that much based on, what an opinion leader might just say off the cuff. So I think that, volatility, there's a ton of regulatory risk still. A lot of governments don't know what they're doing with regulation, with cryptocurrency. There's things being formulated. It's difficult to track in a way of complying with tax laws. If you own Bitcoin and then you use it to pay for something, the difference in what you paid for the Bitcoin and the price of the Bitcoin that you sold when you used it to pay for something else, that's a capital transaction. There's a gain or loss. You have to report that for tax purposes. And right now, while you can get ledgers from certain places as to the price that you bought and sold Bitcoin at, to track if you buy it multiple times, you have multiple lots established at different prices. You have to decide which lot am I selling in order to buy this, whether it's a car or a pizza. You're selling something there, and there's a capital asset transaction that has tax consequences according to the IRS. And every country has kind of their own view of that. So the regulatory world, and then there's governments haven't quite figured out digital currency either. The Chinese government has introduced the digital yuan. They're going to try to occupy some digital currency space themselves. They're really kind of enforcing some regulations that they've kind of had on the books for Bitcoin, but now they're getting much more vocal about, we're really going to control what can be done with Bitcoin in the Chinese economy. Other countries are developing their own versions of digital currency. The US Federal Reserve is looking at the same thing. Again, there's not a lot of track record here. It's just, I think it fits squarely into that speculative pocket right now. And I listened to Ryne explain the kind of the origins of cryptocurrency and the blockchain itself, and that phrase in my head of don't invest in something you don't understand. I think if somebody really wanted to be a wise investor or speculator in digital assets, they probably have some homework to do to make sure they understand what they're getting into.
Kent, are you subtly suggesting that maybe there's a few people in Bitcoin who don't necessarily understand?
I imagine, like any speculative investment, there are people involved who really don't know what they bought. Yeah.
That's good. Well, we're going to wrap it up here, and just I want to open the door to say, do you have any closing thoughts, things that you want to make sure that our listeners leave with?
Yeah, I just hope that people have a better understanding of it. And my explanation is my best attempt at describing what it is. And it's been a journey. And it was a little over a year ago that I started to actually work through what a blockchain is and cryptocurrency. And I still feel like I don't totally understand it. But it takes time, and I hope this video helps explain it. And I think the risks and the nature of the actual commodity of cryptocurrency that Kent described is super helpful for even me to listen to.
I think I'd take away two things from, I think there's a place for most investors or people who think about this stuff to remain humble. And what I mean by that is predicting the future is hard at best. And so the idea that anybody knows for sure where digital currency or digital assets are going, I think is foolhardy. I don't think anybody really knows for sure. So Warren Buffett has a great quote. He says it a lot of different ways, but it basically goes like this: don't risk something you need in order to try and get something you don't need. So it goes back to that. When you think about your portfolio, don't put at risk the things you need by chasing something, in this case, maybe a potential return through digital assets that you really don't need to succeed. So be careful of that risk. And then on the flip side of that, I'd say for investors who remember how things were in the late 1990s when the internet and the dot-com bubble was forming, the thing to remember there is the internet was a relatively new structure, and people's opinions of kind of how useful this thing is going to be were all over the map. Well, today, 25 years later, let's say, we look back and go, hey, the internet is a super valuable piece of infrastructure, and companies that have learned how to use the internet for different kinds of commerce have been wildly successful. You know, again, think Amazon and Apple, the companies that we talked about before. So my best guess is that this blockchain technology and some of these digital assets, you know, I don't know if this is the 90s or not for these kinds of assets, but I think there's probably some really fundamentally good things happening there. We don't necessarily know where they're going to end up today, but I'd always beware of being dismissive of technology, of advancements that maybe, hey, they're new to me, I'm not necessarily comfortable with. But to be dismissive, to not remain in a humble posture and say, you know, maybe there's something to learn here and to pay attention to, I think that's really valuable. And that's why I really appreciate Ryne's, you know, time spent reading, thinking through the kind of the underlying foundations of this thing, because whether or not it's Bitcoin, there may be other things emerged from this kind of thinking, you know, cryptocurrency, or just assets and contracts that are based on codes and systems versus intermediaries as we have today. That could really transform some markets and the way transactions and contracts maybe are done. You know, the US, we're fortunate to have a very stable system, but if you're in the other parts of the world without stable systems, you look at that and go, hey, there's a lot of potential for people around the world in those kind of systems.
Well, I want to say thank you very much to the two of you. And just, I want to speak personally myself. So I found conversations with these two tremendously helpful for me. I've had a couple of detailed conversations with Ryne specifically that have helped me really understand what this stuff is. Obviously, we hope that you're leaving with a better understanding. I bring that up just to say that we enjoy this stuff at Foster Group. And so if you've got questions about crypto, blockchain, NFT, DAOs, whatever else is being thrown out there nowadays, call us up. We would love to sit down and actually talk with you about all of this stuff. We want to open ourselves up to that and let you know that this is enjoyable for us. So anyway, thanks, Kent. Thanks, Ryne.
Thank you, Jason. Enjoy.
Thanks, Jason.
Yeah.
Okay, bye.